Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I'm very excited, always excited as I start these episodes. And how could you not be excited? There's so much interesting stuff happening in markets. So many stocks that we know are up.
Yeah.
So that's pretty exciting. We'll touch on that today. But another big episode of Equity Mates. We're going to talk about the news, moving markets. We're going to answer a question on gold, investing in gold and how it can fit in a portfolio. Gold's done pretty well recently, so certainly front of mind for a lot of people. But then probably the most exciting thing, the thing that I'm most excited about and many people are excited about, is we're going to hear you take the next steps on your journey of turning $500 into $5,000.
Yeah, well, stick around for it because I tell you what, I'm on fire.
And we should say attempt to turn 500 into 5,000.
It's been good. So we'll get into it.
Okay, all right. Well, before we do that, let's start with the news, moving markets.
News and markets.
So, Bryce, as I said, it's been a good start to the year for a lot of very well-known companies.
Yep.
And we've got a bit of a list here to give a snapshot of just how things are moving. So, year to date, what are we? A week, 2 weeks into February. Raise is up 45%. Supermicro up 42%. Palantir up 47%. Spotify 36%. Reddit 36%. Pinterest 30%. Atlassian 30%. Megaport 23%. Domino's Pizza, 22%, Starbucks, 22%, Telix, 20%, Meta, 19%, Hub, 17%. Some very well-known names, all up double digits. Hell, even Harvey Norman is up 12%. So my question for you is this investing thing easy or what?
Investing's so easy. You'd actually be a bit disappointed though if you were looking at the indexes. So S&P 500, after all of that, the S&P 500 is only up 3.5% year to date. Same with the ASX 200, 3.5% year to date. So it just goes to show the impact that some of those big top-end companies have on the market, because you think about what's happened and what is driving those big US companies. Nvidia has had a rocky start. Apple had a rocky start. Alphabet, rocky start. Microsoft, somewhat rocky start. So these big tech companies that make up such a massive proportion of the index have been driving that. Same here in Australia. You know, the banks and resources been sort of jostling around a little bit as well. So goes to show why keeping index investing is awesome and makes up 80% of our portfolio, but just goes to show the opportunities that do exist in the satellite space if you've got your eye on it.
Before we get into some of these names, just to illustrate how awesome index investing is, I did some maths earlier today. If you had invested $1,000 at the start of 2020 in the S&P 500 and just held it, IVV, the ETF, by the end of 2024, you would have doubled your money.
Wow.
So through COVID, through cost of living crisis, through inflation crisis, through wars in the Middle East and Eastern Europe, through everything that happened over the past 5 years, 13 interest rate rises in Australia, a number of interest rate rises over in the US, you would have doubled your money. A $1,000 turned into like $1,956. So that's the power of the index.
That's easy.
Now, with that being said, that's why we love the index. We're the index boys, and that'll never change. But of all those companies, those well-known names that are just ripping to start the year, any stand out to you?
Yeah, so the first one that stands out that I'd like to talk about is Palantir.
Okay.
So Palantir is up 47% year to date. It's actually a company that we spoke about on the show, I reckon, early days equity mates.
So we were doing early days equity mates, and then when we were doing a hypothetical portfolio,
Yes.
before the Finfluencer crackdown,
I put it in when it IPO'd.
You snuck it in without telling me.
Yeah, I put it in, and what a call it was. So,
Did you put it in your actual portfolio?
no, because I didn't understand it, and I still don't kind of understand it, to be fair, because
Okay.
they're very, I guess, protective of what they do for various reasons. But let me just talk through it, because I've tried to consume a bit of information around it to understand what the hell's going on. So there's a thesis with what's going on in AI at the moment that a lot of the winners longer term are going to be those companies that can control very exclusive proprietary data sets that no one else gets access to, and then they can charge a shitload of money off the back of having control of that data set. And I guess on the flip side is what we're seeing at the moment, like a lot of companies now leveraging these large language models and providing them to us, the consumers, for very low price. I mean, DeepSeek's come out at an ultra low cost. Or we're now even seeing the big tech companies like Apple now integrating large language models into our phones for free. And so like the winners are actually the consumer. Apple's not actually making that much more money from providing us with AI functionality. And so this is where Palantir comes into play, because their business is having access to exclusive data sets that very few other businesses have.
I think that their business is helping organizations with exclusive data sets understand those data sets.
Yeah.
Like the military and the CIA and police departments.
And half of that business is the government, is the US government. That once you're in that ecosystem, you have a sticky customer.
To understand Palantir, you have to understand how it was set up. It was set up by Peter Thiel and Alex Karp, two very ideologically different, opposed people, but from the tech world, who thought that the government, and particularly the military industrial complex within the government, weren't benefiting from all the technical innovations coming out of Silicon Valley. And so, they were trying to organize the data for the intelligence services. They were embedding Palantir engineers with military, like US military units in Afghanistan and Iraq. Super mixed reports early days about how effective they were. But that's exactly what it is. It's like, how do we help these organizations figure out their data and optimize their tech?
Yeah, and so they've split it. They have two, I guess, analytics functions. One's called Palantir Gotham, which is for government, and one's Palantir Foundry, which is for commercial. So just to put some numbers to it, Q4 revenue, 828 million, up 36% year on year. We know that where revenue growth goes, stock price goes. 64% growth in their commercial business, 45% growth in their government business. Net revenue retention, 120%, meaning they are able to extract an additional 20% from all of their customers year on year at the moment, and expectations of revenue growth going into this quarter as well. So it's pretty interesting.
Yeah.
A company that has certainly found itself right in the middle of this AI craze.
Yeah. Still wonder about its moat, but I agree.
Their argument, I guess, from what I've been reading, is the moat is the relationships they have with government. It's just so hard for someone else to come in and say, hey, we'll do it 20% cheaper. Pentagon really not interested in that. They're like, we just are working with these guys. They're so entrenched. These contracts are so long term. Yeah. For me, that would be their moat at this stage.
I get it. But it's like, I would value that in the same way I would value a professional services firm then, like a PwC or an EY, not a high-flying tech company.
Yeah, well,
because it's so
put AI in
people-intensive.
everything.
Anyway, but that's always been my question around Palantir. But this segment isn't about Palantir, because this is just one of the many companies that have ripped. One that caught my eye, not a tech company at all, is Starbucks. Mm-hmm. And for me, the really interesting thing is understanding their new CEO, Brian Nichols, who was paid a stupid amount of money to get out of Chipotle. Yeah. I think it was like $100 million or something.
Yeah.
The reason he is so sought after, Chipotle, I was having a look at, so Chipotle is, for Australians who aren't familiar, it's like a Mexican fast casual restaurant. Think of it as Zambros or a Guzman y Gomez. When Brian Nichols was CEO for 6 years, just 6 years, 2018 to 2024, the stock 10-bagged.
Wild.
It added up 1,000% to the share price in those 6 years. Another reminder that you don't need unknown companies. Like Chipotle was massive. And so Brian Nichols has now gone to Starbucks, which is really struggling. He's unveiled their new plan. And basically a key part of it is just to return to Starbucks' roots. Mixed success so far. There was a lot of celebration around him changing the rule that anyone could just hang out in a Starbucks, use their Wi-Fi, use their bathroom. And he's instituted you need to buy something to hang out in Starbucks, which the market liked. But then he's also instituted a rule that baristas need to handwrite names on coffee cups and are meant to like write a message or something. People aren't loving that.
Who aren't?
Like the
staff
baristas
members,
and people who have to wait longer in line.
Yeah.
Yeah.
I mean, it can't be that much longer, but yeah, I get it.
Yeah. Anyway,
Nice.
I think an interesting one to just keep in mind.
We're writing names on cups, 10 bag Starbucks.
Starbucks is up 22% this year because the market loves Brian Nichols.
Yeah.
And the question is, can he deliver?
Yeah. Couple of other quick fires for me. Spotify, everyone knows it, but they've just had their first profitable year in 17 years of operation.
Yeah.
Q4 revenue up 16% year on year. Monthly active users, 675 million. That's 1 in every 12 people on the planet now using Spotify. That's an increase of 12% year on year. Apparently, the biggest growth driver this year of new active users was their Wrapped.
Yeah, it's the best
wild.
marketing thing I've seen. Like the idea that marketing is all about getting in front of new people, and the best marketing is getting in front of new people from a trusted person, like a friend showing you something.
Yeah.
It's like literally this is a machine for people to share Spotify to their whole personal network.
It's awesome. Yeah. Premium subscribers up 11% to 263 million. It is worth noting as well that in the last couple of years, they have increased their prices across the globe. Inflation adjusted, it's actually cheaper now than it was 2 or 3 years ago.
Yeah, interesting.
Yeah. So yeah, definitely. And I mean, the share price, it's absolutely killing it at the moment.
For me, it's just like Spotify is profitable because they took all of that podcasting investment and binned it.
Yeah.
They spent $2 billion on
just
podcasting.
Recognized their mistake.
Yeah.
And just said, let's just make it available to everyone.
Yeah. Let's stop commissioning new shows.
Yeah.
Let's stop paying
no
multi-million
value
dollar
in it.
figures to get the Obamas or the Sussexes to make podcasts for us. Yeah. Spotify, interesting one. I actually have started using YouTube Music more.
Okay.
And that was actually,
good.
I was kind of thinking maybe that's a sell signal for me to get out of Spotify, just because I'm finding the algorithm just keeps feeding me the same shit. And I like discovering new music. And I found that Spotify was really in a circular loop.
Yeah.
But luckily I didn't sell the shares because it is doing well. Back here in Australia, I think it's worth talking about Domino's. Long picked as a growth stock. And there was always a question about how big could a pizza franchise get.
Yeah.
And they kept growing overseas. They got to 3,800 stores, including 1,000 stores in Japan. Don May started pitching them as a tech company. He built a tech incubator. There was all the technology in making pizzas, but also delivering pizzas. The Drew, do you remember the robot?
Yeah.
The autonomous robot that would deliver pizzas. Don't see that on the street much. But Domino's has been struggling. They got probably too big, got a bit over their skis, and there was a number of non-profitable stores. Don May left. New CEO Mark Van Dyke has come in. He announced the closure of 205 loss-making stores. Now, 172 of them are in Japan, where they have 1,000 stores. So, in the scheme of things, it's not a huge percentage, 205 stores out of 3,800. But I think the thinking of rationalizing, of focusing on profitability rather than just continuing to grow, the market liked.
Yeah.
And that's why it's up more than 20% already this year.
Nice. Well, that's a good segue. Quick shout out to this next company. We often get a bit of heat from focusing on the big end of town, Ren. So this is an Australian company that has doubled its market cap in the last 12 months. It is Raise Invest.
Yeah.
We all know it, the micro investing company. Market cap now of about $90 or $87 million. It is up 47% year to date. And that is off the back of a very similar story story around focusing on profitability, and they are now profitable. They have had an increase in active customers and revenue per user and the like, but we know that markets like it when companies like Zip is another great example, when they can show a turnaround story and start getting some runs on the board from a profitability point of view, the stock starts to run. So keep an eye on that one.
Yeah, so there's obviously too many stories to talk about to start this show, but if you want to keep up to date with the news moving markets and the company's moving markets, then head over to our daily news email. The link is in the show notes. It's in your inbox, 6 a.m. every morning, unpacking the news of the day. But also, we've turned it into a podcast. We are trying to keep up with AI, and we're using AI to turn our daily news email into a podcast. It's called Headlines by Equity Mates. You can check it out wherever you're listening to this.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, friend. I've got a question.
Questions.
Answered.
We love getting community questions in, and today we have one that is coming from Prasad, so let's give it a listen.
Okay, guys, I'm Prasad. I started listening to you guys recently. What do you thought about having gold ETF on your core portfolio? Because some people are saying it's going to go down this year. Just want to know what you thought.
Love it. Thank you so much for the question, Prasad. A reminder that if you'd like to ask us a question and get on the show, there will be a link in the show notes or description for you to leave us a voicemail, or you can send us an email, whatever you would prefer. So, yes, Prasad, gold. Great question. Let's start with the performance of gold because goodness me, it's been going well. The last 12 months, gold in Australian dollars is up 43%. It's now about $4,500 an ounce. Gold in US dollars is up about 38%. It's about $2,800 an ounce.
Yes.
Now to, I guess, cover off the question from Prasad around expectations, had a bit of a look online, and analyst expectations do vary. UBS has it as low as $2,600 for the year, Bank of America as high as $3,000. Not a huge spread considering it's at about $2,800, but definitely I would call that sort of flat.
Yeah, or from here. It's had an incredible run.
Yeah.
So the question isn't how's it going to go this year. If you're thinking about, adding a gold ETF to your core portfolio, you really have to think about it longer term. And we can talk a little bit about some longer term performance of gold in a second. But if we keep it, I guess, theoretical, the reason you would have it in your core portfolio is it diversifies your portfolio. Like it has low correlation to some of the other assets in your core portfolio, namely stocks.
Yeah.
Store of wealth and hedge against inflation. Yeah. So as the currency inflates and gets worth less, gold it has traditionally been a good store of value.
Yeah.
So that's why you would have it in there. But let's call a spade a spade. Why you have it in there is because you want it to grow over time.
Yeah, you want to make money.
That's why you have a portfolio.
Yeah.
And I came across these numbers that I think illustrate how gold has gone historically.
Okay.
Past 20 years.
Nice.
From 22 years. In 2003, gold was, in Australian dollars, $500 an ounce. In 2025, gold is $4,400 an ounce. So that's up about 800% in that time. Pretty good.
Pretty good, yeah.
But investing is a relative game.
That's true.
And it's not about how something has grown in isolation. It's about how something has grown relative to all my other options.
Yeah.
So if we stay in Australia, the last 22 years, what asset would we have loved to have been in?
Property.
And more specifically?
Residential property.
And more specifically?
Sydney residential property.
Okay, so let's compare the pair. So gold went from, in 2003, gold was $500 an ounce. The median house price in Sydney was $500,000.
Wow.
Now gold is $4,400 an ounce. The Sydney median house price is $1.7 million. So gold is up 800%. The Sydney median house price is up 240%. So gold has outperformed Sydney house prices. Put another way, Sydney house prices are actually down 60% in gold terms since 2003.
Yeah.
Now, for context, wages in that time I think are up about 100%.
Okay.
So wages haven't kept up with any investable assets, which is why you need to put your money to work, which is why you need to invest. Now, property bulls are sitting here and listening to us and saying, yeah, but you don't get the tax benefits or the leverage with gold that you do with housing. Sure, but on an asset-to-asset basis, just comparing the pair, gold has done well.
Love it. Well, if gold does well and we know theoretically why it should be in our portfolios, the question is then, well, how much should I be allocating into my portfolio? Again, from everything that we've learned on the show, generally 5 to 10% is a rule of thumb if you want to have an allocation to gold.
Yeah.
Like it's your traditional, like not defensive play, but for all the reasons you said, diversification, store of wealth, like it can just sit there and do its thing. I mean, it has almost 10 bags in 20 years, so we can't say it's not going to deliver you the returns compared to some of the big tech names, but 5 to 10% is generally how we see it in a lot of portfolios.
Yeah. So there's a few options when it comes to gold ETFs. The most important thing is you understand the gold ETF you're buying. Because there's three categories. There's synthetic gold ETFs, which track the gold price using financial instruments. Then there's physical gold ETFs, which actually own the gold. And then there's gold company or gold miner ETFs that you'll see. And they all are quite different, like they all will be correlated to the gold price. But for us, you want to have if you want to track the gold price, and you want to own an ETF that actually owns physical gold. The reason that gold miners, they're more of a leverage bet on the gold price, but there's just risk that comes in with that, like there's risks with the mining industry, or there's, there could be company tax changes, or there's just companies could go bust. And it's like, you just, if you want the price of gold, track the price of gold.
Yes.
Yeah.
So to do that, there are three that we've come across here in Australia. If you're overseas, make sure you look for the equivalents. There's the Global X Physical Gold ETF. The ticker is ASX Gold. I think it's the largest in Australia. It tracks the spot price. It's backed by gold sitting in a vault over in London. It's unhedged and has a management fee of 0.4%. Then there's the Perth Mint Gold. Its ticker is PM Gold. Again, tracks international gold price, backed by gold bullion that is stored in the Perth Mint with a government guarantee, and it has the lowest management fee among ASX listed gold ETFs of 0.15%. And then there's the BetaShares Gold Bullion ETF. It is currency hedged. Its ticker is QAU. Again, backed by gold, hedged in AUD to minimize currency risk. Yeah, they've got vaults. I'm not sure where they are, but there is actual gold sitting in a vault somewhere. Yeah. So that's what we mean. There's literally gold sitting somewhere back in these ETFs. So
QAU is also in London in a JP Morgan Chase vault.
Nice.
It has the highest management fee of the three, 0.59%. But BetaShares would say, well, the additional management fee is for the currency hedging. Yeah. So it's just, do you want it hedged or unhedged? We've done content on choices around hedged or unhedged ETFs that you can find in our back catalogue if you want to think about that choice. Final question for you, Bryce, as we close out this gold conversation. Do you own any in your portfolio?
No, I used to own gold, the Global X. I don't anymore. Feel like I just wanted to go all in on equities. That's the only reason.
Has this conversation changed your thinking on that?
I mean, I always toss and turn about it, yeah, but then I always, to your point, find myself going, 5% in gold or all the other tantalizing stocks that we spoke about at the top of the episode. Do you know what I mean? I just come to that point where it's like, if I'm going to put my money to work, is it gold? Those numbers have really helped me though. Like I didn't realize that over that 20-year period, it's done so well. But yeah, what about you?
I don't. It is interesting, and maybe I will at some point. But right now, I'm pretty happy with where I'm at with my investments.
Good segue though, because I tell you what I do have is a gold mineral explorations company in the 500 to 5,000 challenge. So we might take a quick break, and on the other side, I'm going to give you an update on where I'm at trying to turn $500 into 5,000. We'll be right back.
Welcome back to Equity Mates. Bryce, this is the time that I've been waiting for. You set out on a big journey this year, the hero's journey, to try and turn $500 into $5,000.
10 bag.
10 bag, a small amount of money in a year. Now, near impossible, I would say.
Bloody hard.
Like, people obviously do it, but people get lucky often. Like,
Big time.
they might be right about a stock, but the idea of 10 times in your money in a year,
Yeah.
well, no one's doing that. Like, no professionals are doing that. So
No.
let's temper our expectations.
So get off my back.
But you did start the show by saying you were hot. You said you were on fire.
Yeah.
So-
No regrets.
So, over to you.
All right. Well, I've got two clips here. One that is a summary of week one that is a summary of week two. Ren, what we might do is I'll play you the first week because you haven't really got an insight into what's going on.
No. We'll save it for the podcast.
Yeah.
Don't tell me how you're going. And now we're here.
So just to contextualize it, if you've just joined us, I started right when DeepSeek hit the markets and there was that AI rout. And on the last segment a few weeks ago, I said I was going to buy NVIDIA to try and get a bit of a rebound on that. So let's pick it up from the start of week one. Alrighty, it is day 2 since I made my first trade, NVIDIA and Vertiv, and all I'm going to say is this: what an emotional roller coaster I feel like I'm about to go on over the next 11 months. I cannot spend every day checking the markets. I need to just get some trades in and hope that they do their thing over a number of weeks. Got to remind myself, people always overestimate what they can achieve in a week, underestimate what they can achieve over the long term, over the years. So daily trading, I don't think is going to get me there. 23% is what I need month on month, a massive hurdle. But here's where I currently stand. So overnight, Vertiv holdings went up another 5%. So I'm in a good position there. Obviously, still a lot of uncertainty around NVIDIA because whilst it rebounded after the DeepSeek turmoil, it fell again about 5% overnight. So my net position currently down $4 when you consider brokerage and exchange or FX fees, unfortunately. Not the start that I was hoping for. The stocks are going okay. I'm going to stick with Vertiv, but I think what I need to do is find some rebound stocks or some oversold stocks or some stocks that are in breakout outside of the AI ecosystem, outside of the AI bubble, because everything's being sort of washed around with this DeepSeek and with what's going on with NVIDIA. So I need to get out of that. That's going to be my next port of call. Okay, so we're picking up a bit of steam here, which is good. We've got some Equity Mates listeners that are keen to get on board. Toby's keen. Toby Coulter has reached out. This sounds like fun. He's keen to get on board. Harrison has actually given me a stock tip, IPD. Now, IPD is, I think it is, ImpediMed. So I'll look into that one. Keep that one coming. Thank you, Harrison. There's plenty of chat going on the Facebook page as well. So get involved. I want to hear your ideas. So Saturday morning, end of week 1, and I'm reviewing what has happened. So start of the week, I jumped in on NVIDIA, which was down 17%. I also jumped in on Vertex, which provides infrastructure for data centers. It was down 30%. It had been the number one stock that fell the most during this week in terms of the fear that was out there from DeepSeek. So I jumped in on that. NVIDIA was trading sideways for a few days. I don't have time to waste on stocks that are going sideways. There was too much wash. So I jumped out of that. After a few nights of being up at 11 o'clock trying to get in when the US markets are open to try and sell so that I actually have some cash to put into other stocks while it's open during the night. Anyway, jumped in on Spotify. It kept coming up on a screen that I've built that shows stocks that are in a breakout. So I jumped in on Spotify. I've ended the week 0.8% up on Spotify. Vertex 11.56% up. So I'm pretty proud of Vertex, almost 12%. I outperformed the S&P 500. The thing that's killing me is brokerage. So in terms of total return for the week, only 3.14% when you consider my loss on NVIDIA, which was 1.23% down, and the brokerage that I'm copying. So 3.14%. S&P 500 was up 1.5%. So I've beaten the market. but seriously need to look at what I'm going to do with brokerage next month. So that's the end of week one.
Wow.
Roller coaster.
I feel like
coaster.
there was more patting yourself on the back about the number of equity mates that had got involved than there was
Well, I love
trading.
hearing the community. So if that was a bit all over the shop, long story short was I only just ended up the week. Only just ended up week one.
Yeah.
So lost money on Nvidia and was getting absolutely killed on brokerage.
Yeah. Still made some correct stock picks though, Spotify and Vertiv.
Absolutely. So Spotify, as we spoke about at the start of the show, is still running, and Vertiv, it did really well. It has somewhat sort of subsided a little bit at the moment. So how about we get into week two?
Yeah, let's do it.
All right, so it's the start of week two. Over the weekend, Trump imposed 25% tariffs on Canada and Mexico, 10% tariffs on China. So I'm anticipating that the markets to start the week are not going to be very favorable. Have considered a leveraged short on the US. That can be done through some ETFs. I'm still fully invested, so I'm going to have to wait for markets to open US time Monday night. Obviously, I want to try and end this week up. Losing any money really dents this goal that I need of 23% every month. So it's going to be a bit of a washy week this week. But as I said, I'm kind of keen on this Aussie Gold, Explorer and TEPA. So I really need to figure out my liquidity, make sure that I don't react too quickly to this tariff news. But I do expect markets to drop when they open in the US. All right, so I have set myself about 40% of my portfolio is now sitting in Antipa Minerals, AZY. Anyway, we're going to see what happens. This is a stock that I'm just going to sit on because not expecting the acquisition to happen overnight. Hopefully in the next 2 to 3 months, I've left about $100, or I imagine there's going to be a little bit less after I sell out of or get out the cash from the US positions. But yeah, let's see how this bad boy goes. And TEPA, the stock is AZY. All right, so I've just woken up after putting in my 2 sell orders last night for Vertiv Holdings and Spotify. Anyway, one of the struggles with overnight trades is I didn't do any limit orders. I actually just did market order, which was rookie move. Markets opened, fell pretty quickly, and then recovered pretty quickly after that. Vertiv fell pretty considerably, and then I sold at about, the order kicked in at about $105, and then it bounced immediately and subsequently ended the day up. So that's annoying. However, I did manage to pick it I bought it at a lower point, so I still remained up in the green on that stock. Spotify also dropped at market open. The order kicked in. As soon as it kicked in, the stock seems to have rebounded. I've probably lost about 1% on Spotify. So anyway, that's what happened overnight. Lesson learned. Trading the US stocks is difficult if you're not going to go limit order. But anyway, it is what it is. Alrighty, so for the remaining money I have left, about $89 or thereabouts, I'll need to do a double check. Currency is fluctuating, brokerage is all over the place, so I need to get share side out, plug it all in and actually see where I've landed. But I reckon about $90 is the cash that I've got, and that's what I'm going to put in to Super Micro. This has been a stock that we've been talking about in the office for a while. A lot of buzz around it, a lot of risk around it, but hey, that's what we're here for. Super Micro, they provide like the cooling racks and infrastructure for a lot of NVIDIA's GPUs. Elon Musk is a massive customer. So I'm in on Super Micro. Unfortunately, with the broker that I was using, whilst it's at $0 brokerage, they don't do fractional, so that's annoying. But nonetheless, the $80 or so should or did cover the trades there. So Super Micro, about 10% or 20% of the portfolio, and the remaining 80% is in Antipa, and I'm going to stick on that for now. Right.
Okay.
A lot to digest there.
So just give us the answer up front. Where are you?
So I'm 20% up. I've turned $500 into $600. Well, $597.63.
I mean, it's good. Don't get me wrong. You've added 20% in a month.
Yeah. Well,
just
less.
A lot of narrative.
3 weeks.
To get
I know. A lot of narrative to get there, but I need 23% a month. So I'm definitely on track for that. Just to be very clear where I'm at right now, 80% of my portfolio is in Antipa Minerals, AZY. I'm up 16.5% on that. The remaining, whatever it is now, it's more than, at the time it was the remaining 20%, is in Super Micro, SMCI.
Which has been ripping.
I'm up 50% on that stock.
Should have just all been in Super.
Yes, the issue is obviously weighting of this portfolio, given that the position allocation to Super Micro. So that 50% hasn't completely shot the lights out for total portfolio position. But to be honest, I'm pretty happy to be 2.5 weeks into it and up 20%, $597 after the rigmarole of the brokerage that I had to deal with, FX. So now I've actually got, I've split this between two brokers. One that has zero brokerage but no fractional, and one that has brokerage but fractional, so I can decide where I need to be buying. But the strategy from here is I'm actually just going to sit on these for the rest of the month and see what happens.
Nice, okay.
Because I think over trading is just going to kill me.
Yeah.
And as I said, like, you look at these companies that churn out 400-500%, and obviously they're not doing that in a month. You need to be doing this over a number of months.
Well, your whole inspiration for this was Zip, which 10 bagged, but over 18 months.
Yeah. So the thesis around Antipa is that something is going to happen this half, if it's going to happen, from an acquisition point of view. So I'm going to just wait for that moment. If I get halfway through and nothing has, I'm going to be absolutely kicking myself because I have a lot of work to do to play catch up.
So I cannot stress enough how much this is Bryce doing a journey for education and entertainment purposes only.
Yes.
And what he is doing is certainly not, it's not even general advice.
No.
It's just a voyeuristic look into one man's quixotic journey to 10-bag his money. But yeah, not personal advice. Bryce doesn't know your circumstances, and he's only investing $500, which you would have otherwise pissed away at the pub. So only invest what you can afford to lose generally, but I just can't stress that enough.
Yeah.
As you talk about specky gold miners.
Well, and let's put this into perspective. The S&P 500 up 4% in the last month. So I'm also happy that I've at least been able to outperform the S&P 500 to the tune of about 15%.
But you know what? Full credit, you're on your journey.
Yes. I'm enjoying it. I mean, it's giving me more opportunity to take a look at some of these stocks that I would otherwise not really get so actively involved in.
Nice.
Yeah.
$100 in profit, 4,400 to go.
That's it.
We'll check in next
time.
time.
And for those people that are on socials being like, I bet you haven't even considered tax. No, I'm not considering tax. This is just gross return at the end of it.
I mean, like, you'll get to the end of the financial year and there will be a tax bill.
Yeah. Yeah, definitely.
Like that, let's not count that to your return.
No. This is just gross return at the end of the year. Have I made it? Yeah. So, again, would love to hear if you have any stocks that I can put on the watch list. I'm not looking to trade anything immediately because both of these are going well. I actually dreamt about Antipa Minerals last night and that it did double. That's how much this is on my mind. But love to hear you. So hit us up at equitymates.com/contact, and each week on our Instagram page, I give a short update on how the week has gone.
Yes, so tune in for that.
Into that.
But that'll do us for today. Wherever you're watching or listening, make sure you subscribe so you don't miss the next steps in Bryce's year-long journey. But Bryce, back to trading.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.